The goal of this video is to understand the global economic shock of the coronavirus. The economic change is as important as the health trend, so it need to be treated as early as possible.
This video is divided into 4 parts. Predicted global economy trend after corona outbreak, brief of US and China economy just after corona, current world economy, how to tackle the economic shock of the corona. An epidemic that began in the depths of China's Hubei province is spreading rapidly. The economic fallout could include recessions in the US, Europe and Japan, and a total of $2.7 trillion in lost output, which is equivalent to the entire GDP of the UK. The starting point for our analysis is what's happening in China, where automobile sales have plunged 80%, passenger traffic is down 85% from normal levels. The economy, in other words, has practically ground to a halt. 4 extreme scenarios of the near future are predicted, based on the past experience in China and the distribution of cases in other countries.
Scenario 1. Let's assume major blow to China, and spill over to rest of world. For the rest of the world, China matters as a source of demand, a source of supply, and a focus of concern for financial markets. China is the world's biggest producer of manufactured components. When Chinese factories shut down, the widgets that go into everything from Apple's iPhones to construction machinery become harder to find. If China can quickly get the outbreak under control, and the world's factory rumbles back to life in the second quarter, then the impact on the rest of the global economy could be balanced. By late February, 80% of manufacturing firms had resumed operations. By late April, production capacity should be back to normal. If that happens, a severe shock in the first half would be followed by recovery in the second.
Scenario 2. What happens if the problem gets worse? In Scenario 2, we assume that China takes longer to recover. Even when factories are back to work, it's not like all the problems are solved. Many factories don't have enough inventory. We also assume South Korea, Italy, Japan, France and Germany, the major economies other than China that have seen the most virus cases, take a hit. In our calculations, that takes global growth for 2020 further down.
Scenario 3. In Scenario 3, we layer on a more severe shock to South Korea, Italy, Japan, France, and Germany. And we had a smaller shock to all the countries that had reported any cases as of the start of March. That includes the US, India, UK, Canada and Brazil, meaning that all of the world's 10 biggest economies suffer a slowdown as they fight to contain the domestic spread of the virus. In this scenario, global growth for 2020 slides to 1.2%. The euro area and Japan go into recession.
Scenario 4. Global pandemic. To capture the economic impact of a global pandemic, we assume that all countries mentioned earlier face a severe shock, equivalent to the drop in growth China suffered. If that happens, global growth for the year goes to 0. Worldwide lost output may hit $2.7 trillion.
Modern U.S. economic history predicts the next crisis will occur between 2019 and 2021. It doesn't tell us where it will come from. The first sign is rise in price of assets, such as housing, stocks, or gold dramatically over a short period. In 1929, it was the stock market. In 2001, it was high-tech stock market prices. In 2008, it was housing prices. This time it could be different. About half the U.S. population is on stay-at-home orders. In March 21st, total unemployment insurance claims rose to almost 3.3 million, highest level in recorded history. Higher than 2008 global financial crisis. In addition, manufacturing activity dropped to its lowest level since July 2012. However, some analysts expect the downturn to be relatively short-lived. China, once the epicenter of the COVID-19 pandemic, appears to be turning a corner. As the number of reported local transmission cases hovers near 0, daily life is slowly returning to normal. However, economic data from the first 2 months of the year shows the damage done to the country's finances. China's slowed business activity is seen in investment in fixed assets, retail sales, value of exports, industrial production, services production. In addition, unemployment rose to its highest level, 6.2% in February 2020 from 5.2% in December 2019. With a fast recovery seeming highly unlikely, many economists expect China's GDP to shrink.
In order to stop the spread of the COVID-19 outbreak, countries and world capital have been put under strict lockdown, bringing a total halt to major industrial production chains. The travel industry has been badly damaged, with airlines cutting flights and tourists canceling business trips and holidays. Governments around the world have introduced travel restrictions to try to contain the virus. More than 100 countries have travel restrictions resulting in far fewer commercial flights.
Supermarkets and online delivery services have reported a huge growth in demand as customers stockpile goods such as toilet paper, rice, and orange juice as the pandemic escalates. When a crisis hits, investors often choose less risky investments. Gold is considered a safer investment in times of uncertainty. But even the price of gold increased in March, as investors were fearful about a global recession. Likewise, oil has slumped to prices not seen since June 2001. Hard-hit countries such as Italy and Spain, which already suffer from high unemployment, are also expecting to see economic blows. While the timeline could vary widely, economies are sure to see abnormal changes in the coming months.
Given the near shutdown of many economies, the International Monetary Fund is forecasting a global recession in 2020. Separately, the UN estimates COVID-19 could cause up to a $2 trillion shortfall in global income. Steps to be taken. 1. Reducing the interest rates of banks, in order to make things easier for borrowers. 2. Central banks should intervene in markets. It should put a lot of money into financial market in order to make it easier for banks to lend into the real economy. 3. Central banks should buy bonds such as government bonds and private bonds. 4. Subsidizing wages of people should be laid off, to prevent short shock from the disease. 5. The government debts can be increased, so that any country can borrow money from central banks as much as they can, to balance their economy. Aggressive implementation of these steps may reduce the negative impacts of an economic recession. On the bright side, some analysts are forecasting a recovery as early as the third quarter of 2020. A variety of factors, such as government stimulus, consumer confidence, and the number of COVID-19 cases, will play into this timeline. In spite of economic crisis, staying indoors, shutting down ourselves and maintaining social distancing is the best thing to reduce the spread of the virus. Stay home and stay safe.